Well, let's focus in now on Capitec and African Bank's loan business. Paul, let's start with Abel and your thoughts on the loan business.
Look, Abel has an outstanding loan book of about 60 billion rand. The trends that JP has alluded to are important to understand. In other words, they give smaller loans to start out with to new clients. There are always hundreds of thousands of people applying for loans every quarter. They give larger and longer term loans to quality customers who demonstrate their ability to pay. The target clientele for these people are people that don't have a mortgage, don't have hundreds of thousands of rand saved in the bank. They are lower middle income people who have fixed employment but who need credit in order to either extend their homes or to send kids to school or to buy a TV or a lounge suite. So those are the kinds of customers we're talking about. I think the environment out there is pressured, and it is pressured not only because of the general economic circumstances, but as we said, because there are more issuances going on. The size of the unsecured lending market has grown to sort of 3 or maybe 400 billion rand. So it is still quite small, but it's a bit more significant. Where Abel is right now, well, the management team there has indicated that they want to make additional provisions, but it's important to note that that business is still highly profitable. It made 1 billion rand in the last 6 months. So we're not talking about people making losses in this environment, merely making lower returns. The yields have gone down.
Jean-Pierre, let's get your thoughts on Abel before we talk about Capitec and the 60 billion rand loan book.
I think it's becoming clear that this loan book has got some issues if you look at the number of non-performing loans, which is just under 30% of the loan book, meaning that that proportion of the loan book, people are not paying all their installments and they've missed 3 installments, so the loans are not performing. Against that, Abel therefore have a provision, and they've needed to increase the provision against the loan book, and they have needed to write down more bad debts against those provisions. If you compare the 2 loan books within Abel, you actually have one within African Bank, the brand we know, and the other one being the Ellerines brand, which is where they lend out money through the furniture stores.
Now, Lewis came out with great results today.
Exactly. So that's another piece of the puzzle that we can touch on. If you look at the African Bank book versus the Ellerines book versus the Lewis book, we are seeing some deterioration in Lewis, which came out with results that showed some stress. But there's a big difference between the African Bank book and the Ellerines book. The write-offs, the credit loss ratio in the Ellerines book is 20% against only 10% in the African Bank book. So you have twice the bad debts in the Ellerines book than you have in the African Bank.
So the Ellerines portfolio is not working for them. What do you say as a current shareholder?
Yeah, look, Ellerines, of course, has more presence in the rural areas and in some of the sort of far-flung corners of the country, given the nature of how that business evolved. So it's always been a lower quality book. Whether or not that is to be a major concern or not remains to be seen, because clearly the management here have decided to increase provisions. I must just point out that saying that 30% of the loans are not performing, I mean, that's a technical term. That has always been the case. So you might have increased the provisions marginally. Ultimately, these businesses write off about 10% of the advances they make. But that's in the model and that's in the pricing. So it's not particularly
like
concerning.
A current shareholder who is hoping like hell this share price is going to recover in the short term. Let's talk about Capitec and what we're seeing again. Now their loan book is sitting at around 30 billion rand, so half that of Abel.
Correct, half that of Abel. If you look at the non-performing loans, they call it arrears. Instead of 30% in the case of Abel, you have just under 6%. So that shows that the quality of the loan book is quite a bit different. I'm sure there's some overlap in the actual customer base, but there's also a significant difference in the target market where Capitec is more your middle income consumer, and you see that in the arrears ratio, which is substantially less than the African Bank non-performing loan ratio. Notwithstanding that, as Paul has mentioned, roughly 10% of both these books get written off, but writing off 10% when you have non-performing loans of 30% is a lot different than writing off 10% when you only have arrears of 6%.
Arrears of 6%. Paul, this is only technical jargon to you. You're going to fight him down?
Capitec's big difference, of course, also is that they have that depositor base. So that's not only a very good source of funding, which we'll talk about a little bit later, it also gives them insight into the conduct of those clients and their cash flows and their ability, therefore, to pick up a certain burden. Both of these players have expanded into motor vehicle loans, into larger and longer term loans. So there's been a big base expansion going on. Capitec, I think, has been a fantastic success story. The graph behind you will tell the story. They've done exceptionally well. They are now, in my mind, becoming very close to being regarded as one of the big 5 in retail banking. not one of the big 4+ these other mice scratching around at the edge of the table.
So who's edging ahead on the loan book, Capitec or Able?
Well, I mean, I think you should ask JP the question first. He's got stronger
JP,
views.
you've got strong views on this one.
I think if you look at the credit metrics, it's clear that the Capitec book is of a higher quality. It's half the size of African Bank's book, so it's also more manageable if risk does start to emerge. They are lengthening this book, so there are some risks. It's not risk-free, but I would much prefer the Capitec lending book to the African Bank one.
You want to come back with something?
Well, I'm not going to question you right here, but 6% of NPLs sounds to me like way too low. But I like the look of African Bank's business and always have, because making money from money remains a very good activity. So,
what do you mean you're not going to question him here? You've just put it out there on television. He's got to respond. You're saying you don't believe that his facts are correct.
How can you write off a larger portion of the,
are you 100% sure?
NPLs?
Well, it comes to the conservatism of the accounting treatment. If you look at the written off book, which gives you some indication of how conservative is your write-off policy, Capitec doesn't have much of a written off book that gets collected on after it's been written off. While at African Bank, you do have some collections coming back even after the book has been written off. So that might give you some indication where I agree with you that you can't strictly compare the 6% and the 30%. But notwithstanding that, if you look what is written off at the end of the day, being roughly 10%, and you look at how the book is performing over time, if you look at the vintage curves, which both these companies give in their presentations, it does seem like the Capitec book is in a much better space than the African Bank book.
And